Hi, we're waiting on Kim to get in and get everything started. So hold on just 1 minute. Hey guys.
Hi.
Okay, I'll make sure my volume's up. Yeah, I don't know what happened, Kim. It was weird. Do I want to change my name? No. Okay. Amanda, did you have some questions?
So I've kind of just picked the three kind of.
Well, see, well, welcome everybody to the Conroe Chambers Financial Wellness Forum. Building a solid financial foundation is important. This event provides you information on how to move forward with your savings, credit score, lending, investing, and retirement goals. We have a panel of experts that will talk about emergency savings, your credit score, lending, your retirement, all the stuff I said right before this. So lots of great information about your financial wellness. Our panelists today include Jessica with 5 Point Credit Union, Jessica, Amanda with Guaranty Bank and Trust, and then Kim with Rock Solid Retirement. Thank you, ladies, so much for joining us. We are recording this and it's going to be shared on our YouTube page this week for our members in the community to be able to watch. So we really appreciate y'all being part of this panel. I love it that it's for women today. We're rocking it. So we want to do a short introduction of everybody. Let's get started with introductions. Why don't you go first, Jessica, and tell us a little bit about yourself and 5 Point Credit Union.
Awesome. So I am the Director of Community Development at 5 Point Credit Union. I've been with 5 Point for 6 years next month, which just seems wild. Time has flown. So 5 Point is a full service financial institution. We've been in business for 85 years. 6 years here in Montgomery County. So I joined in April and we opened our first Montgomery County location in June. So we have 2 locations here in Montgomery County, one on Sawdust Road in the Woodlands, and then one on 1488 in Conroe. And in addition to just providing quality service for our members, we really believe in giving back into our communities. And one of the ways that we do that is with financial wellness and financial education, both in the school district. So we have a full-time staff person that's teaching financial education in the schools so that kids are growing up to be more financially responsible. and maybe not make some of the mistakes we made in college. And then two, we partner with companies to do training like this to help employees be more financially well, because that really benefits companies and helps like reduce things like employee turnover if employees are making better financial decisions. And so I'm actually a certified financial counselor. I'm able to work with our members one-on-one and help them work on plans for improving their wellness. So I'm happy to be here. Thanks for asking.
Yes, thank you so much. Amanda, why don't you tell us a little bit about yourself and about Guaranty Bank and Trust?
Good morning, everyone. My name is Amanda Anders. I am an Assistant Vice President, Commercial Lender with Guaranty Bank and Trust. We're here in Conroe, Texas on South Loop 336. Our biggest landmark, I guess, would be incredible pizza and the Waffle House. Our bank has been around since 1913. We're a very community-oriented bank. We're very excited that they're doing the Montgomery County Fair auction this year. That's a big thing. We like to help the kiddos out there, as well as we also participate in different community groups. Our bank focuses on trying to help you be able to find the right products for yourself and not force you into something you shouldn't be into. We're very, again, community-oriented bank. We want to help the community grow as well as us grow. So we really have the customer at heart when we are talking to them and trying to decide what they would like to do, whether it's buy a lot, build a home in the future, have a commercial project, those types of things. And thank you for having me.
We're glad you can be a part of the panel. Kim, why don't you introduce yourself and tell us a little bit about your company, Rock Solid Retirement.
Okay, thank you for having me this morning. I'm Kim Harris with Rock Solid Retirement, and I have been in financial services for over 30 years. My passion is to work with families and businesses to make sure that they plan, build, and protect their income tax-free. That involves a lot. I have a lot of partners that I work with that help get people where they want to be. I do spend a lot of time doing educational seminars, whether it be for different chamber groups or different women's organizations. And I have a passion just to help people understand what they need to do and help them develop their plan so they can live their life out like and with dignity.
Very good. I really appreciate everybody joining us. I think we're going to start off with Jessica and talk a little bit about her area of expertise. We have some questions for the panelists. We'll discuss that. And then if there's anything that comes up at the end, questions for each other, if I think of some questions, we'll do that at the end as well too. So Jessica, what does it mean to be financially well?
I think that being financially well means something different for everybody. I think that we're all at different phases in our financial life. And for some people, being financially well means becoming debt-free. For some people, it's about building emergency savings or learning to live within their means. And for some people, their definition of financially well, because of the phase that they're in, is more long-term savings. So being prepared for retirement or preparing for their kids' college, which is why having like a panel like this is so helpful, because we're all touching on different aspects that are different, like important to different people. Even though some of the stuff specifically that I talk about seems so elementary and repetitive, I think that because finances are so habitual and habit-based, that it's good reminders for people of the things like, we know what we should do, but are we doing it? And so I think like just like any other form of wellness, right? So when you talk about being physically fit, you can't expect to go to the gym once and drop a pant size, right? My chiropractor tells me I can't go to the chiropractor once and expect to be aligned for life. I can't go to the dentist once and never need my teeth cleaned again. And so financial wellness is no different. It's an ongoing process of kind of examining, taking hard looks at what we're doing and making changes. So I can't really boil it down like to one boilerplate that fits everybody. But I think one general tip that I would say about being financially well is to have some form of emergency savings. This statistic, every time I hear it, it just petrifies me. And it kind of changes from year to year, but anywhere between 60 to 70% of Americans are living paycheck to paycheck. And that is just, when you think about the impacts, like if you've never had to live paycheck to paycheck, you might not understand why something as simple as a flat tire could send somebody into homelessness, right? Like it's because it's just this windfall of events that happen. And so emergency savings like looks different for everybody, but you just have to be prepared because we never know what's going to come up. A medical emergency, car repairs, or something that like is very applicable in this day and age is missing work due to illness. And I know like the government's emergency paid sick leave is running out at the end of this month, and some employers are renewing it, some employers aren't. And so if you become sick, you're going to be unpaid time. And so I think it's just so important to have that emergency savings. Which if you had told me at a time in my life where I was living paycheck to paycheck, just save $1,000, Jessica, I would laugh at you and say like, right, it had been done. And so like, you just have to make it a priority. Save a small amount every day, just kind of examine where you're spending, right? If you're spending $5 a day on coffee, do the math. That's $1,300 a year. So not spending on coffee, you could have saved $1,000.
Right.
So,
yeah, I think that's what I was going to ask you. I mean, early on in my career, I mean, I definitely did that. I mean, I think I probably still live a little bit of paycheck to paycheck, but I'm trying to build some emergency savings and also build for a down payment. I'm hoping to, purchase a home within the next year. And I've had to make some shopping stops on Amazon, like, no, you don't need it just because you have it there. But I'm wondering, how much should somebody be having in their emergency savings? Should it be 6 months, 3 months? Is it tied to like half of your salary? Like, is there a formula for that?
I will say in the beginning, when you're starting at ground zero, no amount is too little, right? Save.
Okay.
Get $1,000 in your savings account, right? And start from there. Then you can start looking at what it looks like to have, a full month's, not salary, but expenses in your savings. And when you're comfortable with that, then you can look at like.
Oh, did she freeze or did we freeze?
You can look at what happened.
Oh, there she came back. You froze for a bit. Technology, don't we love it? 2021.
At least a cute face. I always
it's never a cute face, right? It's always like, yeah.
So anyways, I don't know where it cut off, but I think no amount is too small to start, right? The worst thing you
good.
And so I think if you think of getting to 6 months of savings, that goal might seem too large.
Right.
Might discourage you from starting to save at all.
Yeah, I think that's a great point. Like, just do as what you can in that moment, and don't think. I think like I've always thought like, oh my God, how do I save 6 months when I only have $5 to spare? But I think if you think of it in different terms, that helps too. So I'm really interested in getting some answers to some questions that you have coming up as well too, because again, I'm working on my credit score. So a lot of this stuff is very personal to me because I'm working on a lot of this as well too. So my second question is, we've all needed to use our credit score and understand to have a credit score associated with your credit usage, but what factors determine that credit score?
Yeah, so I think this is so important because, right, we all know that we have a credit score. We've all applied for a loan and been told what our score is and what that means, but like, do we understand how to manage or how to improve it or why some things affect it? And so just at its base, so a credit score is a number applied to consumers. It ranges from 300 to 850. There's a letter grade associated with each of those ranges. And so it goes from A+ for the highest levels of credit score all the way down to E. So as those scores go down, typically interest rates.
Oh, again, not a pretty frozen. Come on, Zoom.
Am I?
And it was, again, it was like this. Let's come on, Zoom. Oh, and Jess is frozen. There you go. Okay, we got you.
You got me. Okay, so
Yes.
as your credit, right? I can recognize this, right? So as your credit score goes down, your interest rate goes up. So when you think about what makes up a credit score, think of it as a pie, right? The biggest piece of that pie for what determines your score is your payment history. So do you pay your bills on time? Do you pay your bills on time? Do you pay your bills? And that's why like the impacts of missing, payments can be really devastating to your credit score. And so that's the biggest piece of the puzzle that makes up 35%. Amounts owed makes up the second biggest chunk, so 30%. And that's not looking at, all of your credit. So, right, if we have a mortgage, then you're going to have a large amount owed. It's more looking at your revolving debt, so your credit card lines of credits and how much credit available you have. 30%, and I know Amanda will talk more about this, but 30% is kind of a magic number in the credit world. Like a healthy amount owed is less than 30% on a credit card, and that's across all line items. So if you have one card for $10,000 and you have $500 or $5,000 charged, you're at like 50% usage, right? So it's on the higher side. If you have 3 cards worth $10,000, one of them is charged all the way up to 10 to the max, but the other 2 have 0 balance. Well, even though that card's maxed out, your overall amount owed is still at that 30%, giving you a
okay. Yeah.
Right. So that's the second biggest factor. The other 15% is length of credit history, which I'm going to circle back and talk about more because this is the one that always just is a head stumper. New credit and then types of credit used. New credit and types of credit used both make up about 10 pieces of the puzzle. So if you are if you're going out and you're taking out a lot of new line items, right? A creditor might wonder why, like what has changed in your life that's making you take on new debt all of a sudden? Is your income stable? Are you not making what you used to make? And then types of credit used. So a creditor wants to see just like a healthy mix of credit. So a healthy balance. If all of your debt is unsecured, they want to see just like a mix of credit. So unsecured loan, mortgage loan, auto loan is always like a good rule of thumb. And then, so going back to length of credit history, this is one that like, I feel like impacts credit scores more than people think. And it's one of the counterintuitive, maddening parts of scores is that you think when I pay off a loan, I'm doing what I'm supposed to do, right? If I take out a loan, I pay it off. That's what I'm supposed to do. And then your credit score tanks, right? For probably somewhere between 30 to 60 days, your credit score is probably going to take like a 20 to 40 point hit for a lot of reasons. One, you're affecting your type of credit used. You're affecting your mix. But 2, you are affecting your length of credit history. So like I always use the example, when I was 19 years old, I got a credit card. I think my first credit limit was $350, right? I was getting charged 21% interest on this credit card with a $25 minimum balance, right? A lot of people had credit cards like this. As I grew up, thankfully, and my income increased, like I still have this credit card. It has a better interest rate now, better benefit, but I get charged a $39 annual fee for keeping this card, even when I don't use it. But I have not closed this card because it is my oldest piece of credit. And by closing that card, I'm going to reduce my length of credit history, right? Another example, and I'll use my husband as an example. He was smart. He stayed away from the credit cards in college, but like many of us, he has student loan debts. And so as he starts paying off student loans, which you can't keep open, right? You pay them off, his score takes little hits as these, we're at a phase in life where we're thank goodness paying off student loans is becoming a reality,
Yeah.
right? But it's negatively impacting the score. And so that's just one of the things I'd like to spend a little bit more time talking about, because I think that that's something that doesn't make sense to most people. I'm doing what I'm supposed to do. Why is my credit
Right.
score? It's not long-term. It typically rebounds and bounces back, but don't be surprised to see a dip when you see those payoffs.
That is so interesting because again, you feel like you're doing the right thing by getting it paid off, but then you're getting a hit a little bit because then that's not showing your history. That's interesting to me for sure. Yeah, I think too, like I think back to when I was in college too, and they had all of the like credit card people up like in the plaza and stuff like that, and like, oh, you get, a free blanket or whatever to sign up, I mean, that's just such a pitfall for college students, I think, because that's what happened to me as well too. So
Thankfully, government practices and government policies don't allow credit card companies to advertise specifically to college students anymore. Not
oh,
that,
that's great.
right, in the form of like college shopping for a date party and I need an outfit, and if I get
Right.
or a department store card, then I'll get 20% off today's score,
Right.
Still happens, but just not, it's more indirect than it used to
Right.
be.
Yeah. I think that's so interesting about credit scores as well too. So let's move on to our last question for you. How would you advise someone to obtain a healthy debt load or become debt free if that's their goal? And that probably is everybody's goal. So yeah, like my question always is it better to put money into savings or pay off the credit card? Again, just drawing from my own past history, say I've gotten an income tax check or a stimulus check and I've paid off the credit card, but then I end up running the credit cards back up. So for me, it's better to save it and then be able to pay off the credit cards. But I've heard the opposite. You should pay off the credit card and then save. So I'm always wondering what, maybe this situation is different for everybody. So
yeah, so you've touched on a lot of points that I like to talk about when talking about debt free. The first thing goes back to having that emergency savings, right? So if you have a lot of debt, you might think that that's important first to pay that off before you put money away. But
right.
if you don't have money in savings and something comes up, then you're going to swipe the credit card. So the number one thing you can do when you want to get debt free is to stop creating more debt. The only way you can do that is to have an emergency savings, right? So that's the first thing that I would say. And also, like we talked about healthy levels of debt, like this is one of those things that is going to be different for everybody, right? Some people want no debt, right? They want to pay off a car. They want to pay off a house, any credit cards or any loans. I think a lot of people are comfortable carrying at least a mortgage and one or two vehicles, right? So in order to do those things, you have to have healthy debt otherwise, right? So you have to have healthy debt in order to qualify for the auto and home loans. And so I think like when it comes to, but going back to your question, as far as like getting out to your far reaching 6-month goals of
Right.
expenses, I will say, and this is just if becoming debt free is truly a goal, right? If you have credit card debt that you want to pay off, paying off a credit card that's charging you 18% interest, that's going to give you a higher return than making 10% on an investment, or in a savings account making 0.25% on an investment, right? Paying off 18% versus saving and making a smaller yield.
Yeah.
So, but you have to have that emergency savings first. And I think when you look at credit cards are the easiest to talk about when it talks about paying them off, because I think a lot of people look at the piece of the pie and think, okay, well, I'm going to rank these cards in order from highest interest to lower interest. I'm going to pay off the highest interest first. But it makes the most sense from a needing a win, needing a pat on the back to do like a snowball effect, right? I know a lot of people are familiar with the snowball effect. So you start with your credit cards or with the lowest amount charged, right? And you pay,
Really?
yes, you pay that one off first. And then you move over to the next one and the amount that you were paying on that card. So like say, let's just say we have 3 cards, right? Our minimum payments are $500, $250, and $100. So if I pay off the card, I'm paying more per month on the card I'm targeting, right? My lowest card. So say I'm paying $300 a month instead of $100 a month. Whenever I get done paying that card, then the next one I target is my next one. So if it's $250 was the minimum payment I was paying, I'm going to take that $300 plus the $250. I'm going to start paying $550 on that card, right?
Okay.
And one pays off. And then, but here's the deal. And if your goal is to be debt free, if that's truly your goal, and even though I talked about credit score and closing accounts impacts your credit score, if you haven't made the changes in your practice, right, to not use that card once it's paid off, close it. Close that card because you got to stop creating more debt.
Right.
Yes.
What's the definition of insanity?
Yes, exactly. And that's why I think like debt, part of all of this, right? When you talk about, it goes back to like making savings a priority, right? Consumption is a drug, right? It is a habit. Some people use other forms of drugs or alcohol or exercise to stress relief. Some people go shopping. It happens, right? Like nighttime Amazon shopping is a thing. And that's the world that we live in, where swiping up on Instagram is so instantly gratifying. And then so exciting to buy, but then it's going to show up on my doorstep like a present to me from me. Those are my favorite kinds of presents, right?
I had that comment yesterday in the office. I got medicine because I ordered some like vitamins through Amazon, and Beth's like, "What are you ordering?" I'm like, "It's vitamins." So she's like, "Okay, that's okay." I'm like, because I like the past couple weeks I've had just orders coming in, but I'm like, it's vitamins, it's legit stuff. So it's funny, we were just talking about that yesterday.
I have a full-time, right? My kids stay at home. I have a full-time like babysitter at home, and like it's my mother-in-law most of the time. And I just feel so judged, like when it's a Target or Amazon, and I'm like, it's diapers, or it's
right.
Or sometimes I'm like, I don't even know what's in here.
Right. I know. It really is a thing. That's too funny. Yes.
So, so I would say, whenever you start tackling debt, you also have to take a look in, that you know how to identify needs versus wants, and you have to make your debt a priority and tackling it a priority. And sometimes that means tracking your spending and figuring out the things that you're spending money on.
Yeah.
And debt consolidation, while it can be great because it can lump things together and give you a lower interest rate, it goes back to examining those habits. And if you're paying off those cards, but you're going to charge them back up, debt consolidation might not be the best option for you. So
yeah, I did that in my younger years too, like used, just somebody that was advertising on TV, and learn that lesson. Cancel those cards or put them away so you don't use them again. So I think we could probably keep talking on and on about these subjects, but I think it was a lot of great information. Thank you so much, Jessica. We're going to move on to Amanda to talk about lending and PPP loans. So Amanda, can you kind of address a little bit about how consumer lending works, and how, as a lender from your side of the table, how that looks for people looking for loans?
Yes, Courtney. So there are various different types of consumer loans. So you have, I would say more your basic loans, which are your car loans. You're going to buy a boat. You're going to buy, an RV, or possibly, a side-by-side. Those types of loans are more kind of like the basic consumer loans. Those, banks don't necessarily require a ton of information, but they do tend to look at, maybe your pay stubs, basic information on that. With those types of loans, depending on what type of bank you have, will kind of determine what kind of rates you might be looking at. So for example, like 5 Point Credit Union will have possibly better consumer rates than maybe Guaranty or different banks. Each bank will have their more specialty, which, like, for example, Guaranty's more specialty is more on the real estate side. So it's not that we want to charge people more money on the auto side. It's just something that we're not competitive in.
Oh, that's interesting. I didn't know that. Okay.
Yeah, so it's a little different, as well as like dealerships. Sometimes they can offer better things than any bank can offer through their sources. A lot of them run 0% interest, those types of things, which you sometimes have to be careful depending on how long you term it out on that side.
Yeah.
But there's a big difference between each bank. So it's always good if you are shopping different banks, credit unions, that type of stuff, just call around, because they can give you an idea. Now, when it comes to consumer pricing, all of it is going to be based on mostly your credit score, such as Jessica had said before, because we have to follow fair lending guidelines. We have to make sure we're lending fairly to everyone across the board. So in order to do that, a lot of it comes down to your credit score, as well as a debt to income ratio, which I'll get to in a little while. What the bank looks at on more the car loan side is not very detailed. Now, when you get to the real estate side, there's a lot more involved on that, especially consumer. And when it comes to a bank, there's kind of two separate things, as well as you'll have your in-house lending, which is a lot with your construction loans, lot loans, residential investments. Say someone who can't necessarily qualify for a mortgage because they're self-employed and they don't have the history, we then help them with that in-house. And then the second side would be your mortgage side, which is called the secondary. Those mortgages are going to be your 30-year, 15-year fixed. Those loans do get sold to investors, but again, it's to get you the best rate possible. So when you get down into more of the real estate category, you really got to take a look at your financial picture and financial wellness. So I know Jessica talked a lot about debt. So you do have to take a look at that. Say you're going to be, like you, Courtney, possibly looking at purchasing a home in the future. Yeah. You want to make sure that you know exactly how much debt you have outstanding compared to how much you make. Which that's called your debt to income ratio. Yeah. So a lot of banks typically like that, as well as on the mortgage side, between 42 to 45%. Every bank is different. They have different maxes. So some might go up to 47. Some mortgage programs may go up to 50. It just depends on what program you're going for. So leading up to these big things in life that you're trying to get to, you've got to monitor, especially your credit, and know exactly where you're at payment wise, how much cash you have going out to pay these items, as well as how much your income is coming in. Because the goal is always to try to, again, reduce debt and have more cash flow coming in than you paying out, instead of paying it all out to the credit cards. Yeah. A really good tool that I like to help customers with, which some customers you might work with for 1 month, some customers might work with for 6 months. It's all the end goal to try to get them to where they want to be. So a really good tool is it's the free annual credit report. So it's at annualcreditreport.com. There is only one website that actually is free. It doesn't give you your score, but what it does is once a year you can pull your Experian, TransUnion, and Equifax. And what this tool essentially does is it'll give you your full credit history, as well as how much your minimum payments are. So if you're trying to look at, possibly buying a certain size home, you need to see how much of your payments are being taken out of your income and how much money essentially you'd have left over. So with this as well, it does help for someone who maybe has collection items and they don't know about them. A lot of times nowadays, the biggest thing is medical collections. People do not know they're on their credit report. I've seen as low as $11 and it drops their score 40 points.
Really?
Yes, and they have no clue.
I had recently heard something that your medical debt doesn't show up on your credit, and it maybe, is it like different state by state, or I thought that was kind of odd. I thought, why wouldn't it? It's still debt.
Yeah, so and they can report to any of the 3 credit bureaus. I've seen
Yeah.
it against all 3. I've seen, for example, a teenager, well, I believe he was 18, he got hurt out of state in Arizona. He decided to come in to apply for a car loan. He had no clue that in Arizona, they posted all this stuff on his experience score,
Wow.
and his experience score was like a 500. It was low. And
Wow.
you have no clue because they don't send you any type of documentation in the mail or anything like that. So it's a really good tool to do this. Now, banks don't necessarily, like if you have a medical collection, they don't necessarily make you pay it off. But again, it hurts your score. So in return, if it hurts your score, it hurts what rate you can qualify for. So it's always good, as well as any type of collection. You know, Verizon might slap something on there. You just never know, Comcast.
Right.
So it's just good to always check all these credit bureaus and make sure you know where you're at, what's up to date. That way you can do that. And right now, actually, due to COVID, they're letting you pull weekly reports for all 3 credit bureaus. So it's not just limited right now to once a year from each of the 3. But it is weekly that way because there's a lot of fraud and different things going on
Oh, that makes
that are
sense.
happening.
Yeah.
So
So, kind of, you talked a little bit about consumer lending, commercial lending, for people who are looking to open up a business. Before we get onto that, I had a thought that came through and now I forgot it. Oh, I think like shopping for, like when you're looking to do a car loan, like shopping to make sure that that bank or that credit union is able to give you, because they work in those areas, or something I've never heard before. So I think that's really, really great advice.
yeah, you just also though, let me make a point to make sure they can quote you some type of rate without pulling your credit. You can tell them where the rate's at, they can give it to you. Don't let them bully you into we have to pull your credit, because
Oh,
that is not necessarily true. We quote stuff all the time, you know, this is what it's going to be if your credit score is this. So if you come in, you say your
right.
credit score is this and it goes up, well then, you know, you're expected that yes, your rate's going to go up.
Yeah.
So definitely don't ever let them bully you into doing that.
Yeah. Another question just popped up in my head. What's like an ideal credit score that, you know, you don't want to be low, but you know, you don't think you're going to be at the 850 mark, and maybe Jessica will know this, or maybe even Kim, you'll know this too. Like, is there a magic number out there? Like, is it 725? I don't know.
So to us, it kind of just depends on what type of loan you're going for. Because on the mortgage side, you definitely want a higher rate. They go with the median of the lowest of the 3 scores, wherever the lowest middle number is.
The lowest.
Yeah,
Oh,
of the 3 scores on the mortgage side. So you're gonna want to, you know, if you want a good rate, you're gonna want to have a good score. So typically, our top credit tier is 730 and up. Each bank is different. So you definitely want to have that. I think the minimum lowest mortgage score right now is it was 650. I think it's still held at that, but that even though you can qualify, it doesn't mean you're going to get the best stuff possible. So
right.
it's always just a good goal to try to keep your payments, keep your balances, things that Jessica talked about, keep the balance with everything, you know,
Yeah.
don't necessarily just because you can get, you know, 60 months interest only on furniture, let's just go charge it because the payment's low.
Right.
Because when you do those a bunch, it all adds up.
Yeah.
So, at least for us, it just depends on where you're wanting to personally be at. Some people
Yeah.
don't care. They're just happy to get a loan. They don't care what rate it's at.
Right.
Others, you know, you really want to try to get the best rate possible, at least in my eyes.
Right. Yeah. So talking about kind of commercial lending, does it differ for consumer lending? Is it completely different on that aspect?
Yes, so it's commercial lending. When you get into that, it's very more detailed. The typical small business doesn't necessarily a lot of the time know what they're going to need or what they're going to need to look at and prepare for when they go apply for a loan, which is why we kind of help them through the process. There's a lot of hand holding, which is good because the typical small business owner has no clue, which through the PPP program, it really shows, even though that's an SBA government program, it definitely shows, which I'll talk about in a little while. But with commercial loans, you also have various different types, and depending on the amount and and how much you're borrowing depends kind of what information the bank needs as well. So you can go from, I mean, we have equipment loans, we have people who have 22 residential investment properties, lines of credit to go to the auction, regular lines of credit. We have people who construct retail strip centers. I mean, the commercial is very broad. There's a lot of products to that. And there's certain also programs for people who necessarily are just starting out, maybe trying to purchase a building for their business that are newer. The SBA is very great with that. I am not an SBA lender, but they do have very good programs, especially right now. They're actually waiving the SBA origination fee and paying 6 months of payment. So again, those programs are more specific. We do at Guaranty have a specific representative for that SBA loans. Now, when it comes down to looking at commercial loans, a lot of people talk about business credit. I need to get my business credit better, this and that. When it comes to a bank, we don't necessarily look at your business credit. What it falls onto is it falls onto the company that you're borrowing in, the guarantors, and then also, if those guarantors have other related companies that they own a certain portion or more of, we have to take a look at that as well. So it's not as cut and dry. So it really does heavily fall on guarantors. So if you're wanting to own a small business and possibly get loans in the future, you're going to want to make sure you yourself are financially well and healthy, because that's going to help support the bank's decision, also get you a better rate, those types of things. So that's always good to look at. So when it comes to what a business needs to do to possibly prepare for starting to look at loans, they definitely need to make sure they have their financials up to date. That's a big key thing, is when you're going to look for a loan, have your profit and loss, have your QuickBooks ready. Don't be 3 years behind, because typically the bank has to look at the last 2 to 3 years of financials for the business or you personally. So say it's a new business and you don't have financials, you still have to have them personally to move forward on that side. So they also will ask for what's called a personal financial statement. Typically banks have forms to provide you for that, but what that does is it gives the lender a snapshot of all your personal assets as well as all your personal liabilities. So what you own and what you owe. And some of the biggest key factors that banks will look at is they will definitely look at, how much liquidity or how much cash do you have available. So if something happens with the business, is that person going to be able to keep moving the payments forward, or is it just going to, go down in the swamp? I don't know. So it's just one of those things. And then also, if you are a small business, another big key factor is when you're looking at possibly having to get a loan for something and, say the next year or two, you don't want to deduct all of your income off your tax return. If you don't show any income, then the banks can't lend you any money, because we're under certain rules we have to follow too, and regulations and guidelines. So it's very important. That happens with a lot of people who have Schedule Cs, which is self-employed. They always like to deduct. Yes, it's nice not to pay Uncle Sam, but on the flip side, you can't get lending help. So
that's interesting. Okay.
Yes. So we can add back depreciation and interest. Those are two things we can add back. So your CPA can always, if you have assets to depreciate, put a large total in there and say you have a net loss, well, it helps offset it. But if there's none of that stuff, the bank's kind of stuck. We can't help because, again, you don't show the income to be able to cover the debt.
Right. That makes sense. Okay. That's interesting.
Yeah, so it's a little bit bigger of an animal now. What they might use is called a global cash flow. I'm not sure if a lot of people know what that is, but what that means is, say you have Johnny and he himself is going to borrow an ABC company. So the bank has to look at Johnny plus ABC company. Well, what if Johnny also owns 50% of XYZ, 50% of another company as well? What the global is we have to look at all 3 companies plus himself. So we have to run a cash flow number over all 3, which typically has to be 1.25 times or higher. It's really good if we like to see 1.5 times or higher covering the debt. But 1.25 is kind of like the very lowest point that the bank can look at to be able to say, yes, we can do your loan. It's going to cash flow. There's plenty of cash to cover everything.
Yeah.
So it's not necessarily just the one company they look at. They have to look at the big picture. And again, when it gets to the global cash flow, it also sometimes depends on how big the project is. So if you're just going and buying a forklift, it might be a little bit simpler versus someone who's building, say, a bowling alley or something like that. It's going to be different on both sides.
Yeah. Well, that's a lot, but it kind of makes sense a little bit that commercial would be a little bit more in debt than consumer. So I know we want to touch a little bit on the PPP loans. And I know y'all have been very involved, and Nick has helped us at the chamber with PPP since we're finally able to qualify for that. So can you touch a little bit about PPP loans?
Yes, so the Paycheck Protection program has been going on for a year now at different various phases. So let's go back to the start. So when we started, when COVID hit, of course, we have customers, calling us panicking because they have large businesses that have had to shut their doors. Yeah. There's no way on earth that they can pay their payment or get funds. The bank, they can help them, possibly either defer or do an interest only period for the loan at that point. But still, if there's no cash flow coming in and say they have a big project, how are they going to pay their bills? Right. So we had a lot of customers panicking. So the government decided to pass this Paycheck Protection program to help with payroll costs for these companies, to keep people employed, to also keep those people to be able to have a job and pay their own bills as well. So when the program first rolled out, it was a little bit of a chaos that everybody had to navigate and get their own path forward and whatnot, which our bank, I was very proud of because we were able to get together as a team, get everything done, and get procedures in place. We worked pretty much day and night. There's a lot of long nights with it to begin with, but it was very rewarding because those customers who were panicking and upset were now ecstatic because, hey, I can make it a couple more months and hopefully the government will reopen everything and we'll start getting back to where we need to be. Because also with that, they could also use it for utilities as well as, interest rent payment. Now, there is still today a 60%, 40% split. So you have to use at least 60% on payroll. You can use 40% on other. But yeah, so that round happened and everybody got, Guaranty did a great job. We got everybody in of our customers. We also looked at accepting new customers as well. People who were at bigger banks, Compass, Bank of America, different ones who shut their doors or had no clue what was going on. So it really benefited small businesses to be with a community bank because there was a lot of times too where we were able to tell the customer you were approved at a bigger bank before they could tell them they were approved. And so it helped. Yes, so it helped them get a peace of mind. Okay, I know this is coming versus I don't know where my application's at. I don't know what's going on. I applied with this big bank. What do? I can't pay my guys or my women, whatever you may have. So all that happened. So they had the first round, then they had the second round. We're now in the third round of Paycheck Protection Program. With this third round, it's supposed to expire on March 31st, but they already have it in process to extend it to May 31st. Right. Applications would have to be in by May 31st, and then there's still 30 days allowed for processing. So if you're a last minute person, you turn it on before May 31st, say May 30th, you still have the 30 days the bank can still process your loan on that side. With this third round, it allows a second draw for people who've had a first draw. First draw happened prior, and so, hey, they need more money still, they want to keep going. So with the second draw, they allow companies to apply if they had a 25% reduction in gross receipts, which is the number before all expenses, over a calendar quarter. So you had to compare 2019 versus 2020. So you'll have like January through March 2019 versus January through March 2020. as long as your gross receipts show a 25% reduction, that is a qualifying mark for you to be able to apply for the second draw.
Okay, so if you did it the first time, you're able to
Mhm.
also apply for the second time if you meet that criteria. I did not know that. Oh, that's interesting.
Correct.
Okay, good.
Yes,
Yeah.
and they can also use, they give you the option to use your 2019 payroll or 2020 payroll. So
Gotcha.
depending on what your company paid out, in payroll, you can use either or, depending on what you would like to do. It's all personal preference. Of course, like you'd want to apply for the most you can, so you're going to want to use the higher payroll
Right.
you can, but it is a year's worth of payroll. It's not just averaging 2 months. It is a full year's worth, so you do have to look at the 940s and the 941s from those companies.
Gotcha.
Now, also with this third round, the newest thing as well is for Schedule C filers. They made some changes to where Schedule C filers who may show a net loss, but have a gross income in their line 7 item, that they can actually apply now based on their line 7 item, which is your income minus cost of goods sold, and it gives you that number.
Okay.
So unfortunately, they didn't allow for people who've already applied to go back and basically correct their application. It was the time of the application. So it was a good thing for some, but not a good thing for others. But it is the rules that they had made. So that's what you have to kind of go with.
Yeah.
So on that, again, that's opened the doors for a lot of people as well, because they didn't know, or, say they may not have needed the money prior, but now they do, because
Right.
some of these companies didn't get hit till fourth quarter of last year, beginning of this year. So it just depends on what they had happen. And the biggest thing as well, and this also ties into commercial lending, is a lot of small businesses don't have their corporate documents together. That is a huge thing that a lot of people don't have. They don't know that a DBA expires after 10 years. They don't know if they have an LLC. You have to have a company agreement at times, depending on if you're member managed or manager managed. So this has helped a lot of small businesses as well get their corporate documents, sound and good to go. So that way, if they apply for a loan in the future, everything's set up. As well as with the LLCs, you have to record your DBA now with the Secretary of State. That was a change that had come out a couple years ago that a lot of people don't know as well. They're like, well, I have it filed with the county. You can add it to my account as the DBA.
Right. Yeah.
Well, banks can't do that. We have to have, if it's an LLC, the Secretary of State filed DBA now.
Oh, I didn't know that either. Oh,
So, yep.
Okay.
And so back to the PPP side, we are also, of course, once you apply and you use your funds, you're going to want to keep track of all of your payroll receipts or payroll checks. You're going to want to keep documentation. The SBA can come back and audit you for that. So it's always good just to keep it in place, especially if you have a PPP loan of $150,000 or over. Those are the ones that were more, I guess, scrutinized by the SBA. So you definitely want to make sure to have all that in place, as well as while you get your PPP loan, keep it together too, because that helps when it comes time for forgiveness. So we've been working on the forgiveness since the end of last year with all the first round loans, and it's been very, very successful. They keep changing the forms on us with the SBA. Even this morning, I got a new email, hey, new forms from the SBA again. So that's something the banks have to work with the customers with. But the good news is that a lot of loans are being forgiven. I think we did over 100, and I think we may only have about 15 customers left to apply for forgiveness. We're really making sure they get their stuff forgiven early so they have a peace of mind. Definitely do not wait till the last minute because the SBA does take a while to process these forgiveness apps. And make sure as well, if you are with a different bank, to keep up with what's going on with that process. Go ahead and ask now if you had that first round PPP, because yes, it is open to apply for it right now. With this third round of PPP with the second draws, and say if someone is getting a first draw this go around, you won't be able to apply for forgiveness until the 8 or 24 week period out after, because you have 8 or 24 weeks to use the money. So you have to use your money and then of course apply for forgiveness on the back end.
Okay.
But now say your loan doesn't get forgiven, It is at a very low interest rate, or even maybe some loans, possibly didn't get forgiven all the way for whatever reason, whether they didn't spend the last $300 and they didn't put it on their application like, hey, I didn't spend this money. So if it's not forgiven, the interest rate is 1% and you have 5 years to pay it out. So it's a very low payment for a business if that's the case. But again, as long as you use the funds for payroll, at least 60% or more, it's a pretty good chance that you will be forgiven for it.
Yeah, I think that's good information too. Just because you hear it's forgiven doesn't mean that, if you don't do it properly, it won't be forgiven. So I think that's great information. And again, I think we could probably stay on this topic for another hour or so. Just great information, Amanda. Thank you so much. We might have to have a part 2 of this because I feel like we could just keep talking and talking, but I do want to go. Thank you so much, Amanda.
Yes, thank you for having me, Courtney.
Yes, it's been great to talk to Kim about retirement.
Okay.
So I think, people say it's never too soon to think about retirement, but I think when you're young, it's hard to think about that. But I think it's a great topic, and I'm hoping everybody can kind of see how this financial wellness is kind of taking a whole, the whole circle. And so we're kind of closing the circle on talking about retirement. So one of my first questions for Kim is, planning for big goals like retirement can seem impossible, causing people to quit before they can even start. Is there a better way to look at these goals other than looking at how much money needs to be accumulated in order to achieve it? Because that is kind of a big picture and seems a little bit overwhelming.
It is a big picture. It's daunting, and many people get discouraged. They try to do it themselves because everybody wants to do the DIY projects. But with finances, just like you all have listened to Jessica and Amanda, they have a wealth of knowledge. It's really crucial that you talk to someone who does this every day. And you're in it, you understand it, because there's so many people I talk to, their eyes just glaze over. And so when you think of retirement, everybody, loves to plan to have a vacation, and they think about it, they talk about it, they map out what they're going to do. Well, that's what you need to do for retirement. You need to allow yourself to think about, what do I want to do in retirement? What age am I going to retire? Look around at relatives and maybe older people that you work with and talk to them. Just ask them about it. Get some ideas. If your household makes averages $50,000 of income for 30 years, that's over $1.5 million that's going to travel through your hands. And what are you going to do with it? How are you going to appropriate it? How much are you going to keep? And how much are you going to just allow to be consumed with consumer debt because you want that big TV or your boat or whatever, And I've noticed that I think there's really 3 phases of retirement. And the first phase is the go-go years, and then you move into the slow no years, and then you move into the no-go years. and so there's really 3 phases. And because, when you first retire, you're, hopefully people still have their health and a lot of energy, and they want to go do things. But do they have an idea of what they want to do? How much is it going to cost, And then, when you get to that final phase, that's the phase nobody wants to be in, where you might need help. But if you can think about it and maybe put a dream together and talk to a professional about it, then they can guide you through the steps and help you. Because just as you've learned from these other 2 gals, it's a process. It is a journey, and it's not a one-time trip to the gym or to the doctor, or, it's an ongoing process.
Yeah. Well, I think again too, like when you're young, you don't really think about it, but you have to, because eventually you'll be at retirement age. So
that's true. And there's 2 questions that I think that sum up retirement very easily. One is, what do you want your money to do while you are still living? The second one is, what do you want your money to do when you're dead?
Mm. I never thought of it. I thought about it that way, but that's great. Yeah.
Mhm.
Huh. Okay. That's a great way to think about it. Yeah. I just think, oh, I just need to put money away because I need to be retired one day, So
Right.
yeah. So what are the steps that people should take planning their future goal? Like, should you match your company's match? How much should you be putting away? What are those goals that we need to start thinking about when planning for our future?
Okay, the very basic first one is establish a budget. Know what your income is, know what you're spending. That's crucial, no matter how old you are. And secondly, you need to invest in yourself first, because if you don't understand, you're not going to be able to do it. So like there are books you can read, podcasts you can listen to. There's one book that was that I'm going to talk about just quickly. It's called The Richest Man in Babylon. And it's a story about wealth, how to accumulate it and how to keep it. And the one thing he talked about that was a basic is save 10% of everything you make and what to do with it after that. So it's a good read. It's a real easy read.
Yeah.
And then understand the greatest fear people have is running out of money in retirement.
Yeah.
And you need to understand about tax-free guaranteed income in retirement.
Okay.
Because, people in the past and some are right now have the Social Security, but they have pensions.
Right.
Well, pensions are a thing of the past, but what are we going to do? So those are all guaranteed income things, but there are tools that the government has allowed us to have at this point that in the future are not going to be taxed. So, and then the next thing I would say is understand your risk. What kind of risks can you plan for to not devastate your family emotionally, physically, financially? Because, when something happens to a family member, it's not just finances, it's an emotional strain. And I could give you a lot of examples on that. But understanding risk is crucial.
Yeah, I think there's certain things that you just don't plan for. Again, I'm drawing from my own personal experience. I mean, my mother suffered a series of strokes at 57 and became disabled after that. And, thank God my dad did work for a company that has a pension, because I think that definitely saved them. But that's not anything that people can really think about, nowadays, especially in the nonprofit field. There's I don't think there ever was, but there's not a pension base there too. So yeah, thinking of those that are, you're really just, relying on your 401k, your savings. So I think that's a great point to make. Yeah.
Right.
And even Social Security, you keep hearing, especially like my generation X, they were like, when you get older, there's not going to be any Social Security. I mean, we've heard that forever, so,
but there is a plan that you can put in place when you're younger that will take care of that.
Yeah. I think that's a great point.
Right. So you ask about what things you could do, and I totally agree with what Jessica and they've all given excellent information. But establish a savings account for that 10%. Keep at least 6 months in that for emergencies, so you don't have to swipe that credit card. You've got that money in that emergency fund to pay for what you need. And then if you are fortunate enough to work for someone who offers you a 401k, match it. And don't go over that, because remember, what you put in a 401k, you're going to be taxed on later.
So if your company, say, puts in 3%, you should just put in 3%. You shouldn't put in more than that? Oh, I did not know that.
No.
I thought you should put in as much as you can.
No, after
Oh.
you put in your 3%, then there are things that you can do in different financial vehicles, but have every income earner in the family establish a Roth IRA and max it out, because that is not going to be taxed in the future. You pay income
Gotcha.
taxes on it now and then after you max that out, there's other things that you can do to, like I don't like to talk about products because people don't understand them sometimes, but a fixed index universal life for someone young right now, and we can still put money in those and
Yeah.
have tax-free income in the future if you work it properly with loans. But you have to be careful to look at your fees on those. So
Yeah.
it's like, where do you want your fee? Who do you want to pay? Do you want to pay, do you want to pay a financial advisor and have a risk in the stock market for 1 to 1.5%, which is kind of normal across the board? Or do you want to put that, pay that fee within an insurance vehicle that you're going to be able to withdraw tax-free in the future?
Yeah.
So those are
Yeah,
a couple of things.
Yeah, another light went on. I think I had that conversation with my financial person too, like years ago, saying we need I had retirement at another company, and like we need to put that in and I think mine is in a Roth. So that
Good.
like the light bulb went on and went, I think I had that conversation a couple of years ago. So yeah,
Good.
that makes sense.
Good.
I was just like, sure, whatever you feel. I didn't understand it at the time, but yeah.
Yeah. And as far as small businesses or any type of business, there's so many moving parts to a business. I like to talk about individuals and families first. And the other things that I would like to mention are who you have, your CPA and your attorney is crucial. So you don't, you want a professional who understands the business you're in. So if you're a W-2 employee, and I mean, your taxes are going to be pretty simple, but if you own an excavation company and you are working with a CPA and attorney that only understands manufacturing, there's a difference there.
Yeah.
So you need to make sure that the professionals you work with understand your industry. And it's really crucial in businesses to have your taxes set up, your legal structure, as Jessica was talking about, your LLC, corporation, or whatever it is, that needs to be set up correctly legally. And because, do you want the IRS to be the beneficiary of your state, or do you want your family to be? And that's what it boils down to, but people don't understand it like that. So, and so as I work with people, if they have a professional already in place, I just work alongside them. If not, I can give them names of people, this is what you need to explore.
Right.
And make sure these things are done properly.
Yeah. So planning.
Yeah, it really is. And it can be an adventure. I mean, as with anything in life, you can have a negative attitude about it or a positive attitude about it.
Very true.
Yeah.
Very true. Yeah.
And, as far as a business goes, are you gonna work that business until you retire, then shut it down? Are you gonna sell it or pass it to family? Succession planning is crucial. Yeah. And of course, having the proper professionals in place to help you have all three areas, your finances, your taxes, and your legal all set up properly will help you keep the hard-earned income that you're working for.
Yeah, for sure. And I think, so we kind of talked about this a little bit before, but are there accounts individuals or small businesses can set up to plan for retirement? I think you touched on a little bit, but
Right.
So say for instance, you know, I'm getting retirement from the company that I'm in now, but I had retirement from a previous employer. Should you, you know, is there something or accounts that would be the best? Should you keep it in that, you know, at that company, or should you put it in a raw, like, you know, what are those kind of options for people?
Well, one option is to leave it where you had it with your previous employer, which I don't recommend. The other option is to roll it into your current employer, which I don't recommend. Depending upon your age, there's different options of things that you can do. I'm insurance licensed with the Texas Department of Insurance. I have previously had my securities license, but I don't enjoy that part of it, so I don't do that. So but I do want to say that being in the market is an important aspect of everybody's portfolio. But to have everything you have in one place is very dangerous. If you look at the history of our market, you can, you know, there's ups and downs. So the market's always going to go up, but it's always going to come down. You know, that's what it's done. So, you know, planning for that. But so to answer your question, depending upon your age, it depends on if you should leave your funds at risk in the market, or whether you need to put them in a vehicle that protects from market loss, but still you can earn interest on it.
Yeah. Oh my gosh, so much great information there. Even though I've heard y'all at other organizations speak about this, I think I learn something new every time I hear all of y'all speak, and it can still feel very overwhelming, but I think it's just great information for our members in the community to know, for our small businesses, and all of that information. So is there anything before we wrap up that any of y'all want to add to the conversation, or you know, anything that came up during the conversations? Again, I have so many things running through my mind right now too. So
I'd like to say, you know, I've been in the financial industry for 30 years, and the information that Jessica is covering and about credit scores, that is so crucial. Just so crucial. That's a foundation. They need to teach that in high school. Honestly, they really, really do.
And probably in college too.
Yes. And then what Amanda was, you know, went on to expound about how it was important for if you want to have a business. I mean, all of their knowledge is so crucial, because our financial world, I mean, that's why we get up every morning and we go to work, is so we can work, have money, so we can live life. Yeah.
And it's just, I mean, I think everybody, I think I said this before, it seems like we started out with the top of the line and then circled through, and it just, you know, your credit score, lending, in retirement, it all comes together as one. So I think this was great information to have. And, you know, we may be talking about having a second session, because again, there's so many things that I think we could still talk about on this. So I want to thank y'all so much for joining me today. We will have this posted on our YouTube page, and then we'll put your contact information in there if anybody wants to reach out for y'all for more information. But thank y'all so much for joining the chamber for our financial wellness forum. I really appreciate it. Thank you.